Have you noticed that every few years, central banks say, "Don't worry, we've got this under control." And then they have to print another few trillion dollars? Today, I want to explain, with data, why our economic system is trapped in a debt spiral, why central banks are cornered, and why this doesn't mean the world ends tomorrow. But it does mean the next decade will look very different from the last. Let's start with a simple fact. Before the 2008 crisis, the U.S. Federal Reserve's balance sheet was under $1 trillion. After the crisis, and especially after COVID, it peaked around 10 times that size. That's not a normal business cycle. That's a structural shift. Instead of just nudging interest rates up and down, central banks now create money and buy huge amounts of government bonds and other assets. That's what we call quantitative easing. And even after some quantitative tightening, the Fed is still sitting on trillions in assets and has just announced new Treasury bill purchases in December 2025 to keep the system liquid. So when people say they've been printing money for years, they're not wrong. Now zoom out. According to the IMF and UN data, global debt governance companies' households is around $250 trillion, more than 235% of world GDP. Public debt alone hit about $102 trillion in 2024 and is expected to move towards 100% of global GDP by the end of the decade. So governments are not just borrowing for emergencies. Debt has become the normal way to keep the system running. And here's the key point. The system only works smoothly if interest rates stay low. When rates rise, the cost of this debt explodes. Let's talk about assets. In 2008, the crisis started in housing and credit. Subprime mortgages blew up, house prices fell sharply, and the financial system nearly collapsed. Today, the picture is more mixed. In the U.S., national house prices are not crashing. They were still up about 2% year-on-year in late 2025. But under the surface, you can see stress. Foreclosure filings are up more than 20% year-over-year, rising for 9 months in a row. A lot of homes are being pulled off the market instead of repriced lower. Home delistings are up about 45% compared to a year earlier, which shows a big mismatch between what sellers want and what buyers can pay. And commercial real estate, especially offices, is in a much worse spot. U.S. office vacancy rates are above 20%, at or near record highs, which is hammering valuations and putting pressure on banks that lent against those buildings. On the stock market side, indexes have been held up by a small group of AI-related megacaps. Some analysts are now openly warning that AI optimism may have pushed valuations too far. So I wouldn't say everything is collapsing right now, but I would say the system is highly stressed, and it doesn't take much to trigger something big. Here's the real heart of the problem. Central banks and governments are now stuck in a no-win situation. If they keep interest rates high and don't provide liquidity, then over time debt becomes unpayable, defaults rise, markets crack, and unemployment goes up. If they cut rates aggressively and restart large-scale money printing, they support the system in the short term, but they risk higher inflation and a loss of confidence in the currency. We already see signs of this tension. In 2025, the Fed has cut rates to around 3.5% again after tightening, and there's internal disagreement about how to balance inflation risk with a cooling job market. They also ended balance sheet reduction earlier than expected and restarted buying short-term treasuries to keep funding markets stable. So when people say they re-cornered, they're redescribing this trade-off. Save the currency or save the debt-based system. Over time, the pressure is to protect the debt system and let the currency slowly lose value. So this is the big question. Until when can they balance the plates? Honestly, nobody knows the exact timing. What we can say is, each crisis has required more intervention, more debt, and bigger central bank balance sheets than the one before. Global public debt is already at record levels and still rising. The system can keep limping along for years, but the range of safe options is getting narrower. Instead of thinking, collapse tomorrow, I prefer to think in terms of probabilities and preparation. A higher chance of currency debasement over the next decade. A higher chance of periodic market shocks when tightening goes too far. And a higher importance of scarce, non-sovereign assets like gold and, increasingly, Bitcoin. So no, this is not a video saying the world ends next week. What I'm saying is, we're living in a high-debt, high-intervention system. Central banks are increasingly trapped between inflation and recession or credit events. Real estate, stocks, and government bonds are all affected by this tension. And while nobody can time a reset, it is rational to expect more money printing over the long run, and to position part of your wealth in assets that can be printed. If you found this useful, share it with someone who still thinks they can just print forever with no consequences. And let me know in the comments if you want a follow-up video specifically on how Bitcoin and gold fit into this big picture. Thanks for watching.